What is up? Welcome back to another video. In this video, I want to talk about my inverse trading model that I trade every day, but more importantly, I want to focus on liquidity and how to find your entries and mainly your exits when looking at price action. So, first of all, if you don't know what liquidity is, all liquidity is just where money is resting in the markets. So it's where the price action is most likely going to go, so that the institutions can grab the money and enter into positions. So all you need to know about liquidity is just where price is most likely going to want to go. Because without liquidity, then the price action can't move, and that is what the target is. So, how do you find liquidity? Now, there is different ways that liquidity is in the market. They can just be swing highs, they can be swing lows, they can be equal highs, equal lows, they can be trendline liquidity. So, if we look at this right here, this price action on my screen, we have lots of different types of liquidity. So let me just go back before this move. We have our trendline liquidity, which is our low resistance liquidity. So right here we have low resistance liquidity. So all that is if, let's say, we have a retail trader that trades with trend lines, so they would they would draw out their trend line like this. They would have their position for a short. Let's say once price action taps this zone here, they're gonna go for a a retest of this trend line and go short. So us as smart money concept traders, we know that there is lots of liquidity resting above this trend line, just because for that reason a lot of traders that trade retail would have their stop loss above this trend line liquidity, because they think, oh, price has tapped here once, price has tapped here twice, 3 times, 4 times, price is going to come back, tap this trend line, and then carry on going back down. But we know that is most likely not the case, and it is not going to happen. So that is one way that you find liquidity. So just by drawing trend lines, and that is called low resistance liquidity run trend lines. Now the other type of trend line the other type of liquidity is just equal highs. Is just swing highs. So if we look here, there's liquidity there, there's liquidity there, and there is liquidity there. Now there is also so this would be classed as external liquidity, I would say, but then there is also internal liquidity. So let's say that we get into a long position here for no reason, but let's say we see these equal highs right here. So this would be called internal liquidity, because this is liquidity that is very close to the price action, but it is not a swing high or a swing low. It is just equal highs inside of some price action that is consolidating. So that is called just your internal liquidity. So if we was to enter a trade here and the price action came up a bit, then as soon as this was hit, our internal liquidity was hit, then we would move our stop loss to break even, to making it a risk-free trade. So if you ever hear me say that when I'm trading live, and I trade live in my Discord every day, the link is in the description. So if you hear me say we've just hit internal liquidity, then that most likely means we've just hit somewhere where price could potentially reverse from and carry on going down or up, just depending on the market. So yeah, so that is excuse me, I'm a bit ill, but yeah, that is internal liquidity. Now moving to the external liquidity, where price is most likely going to draw to. So we call this buy side liquidity, and the reason we call this buy side liquidity is because the stops are at the top. This is buy side stops. If the stops were down below, then it would be called sell side liquidity. So this is all buy side liquidity, and then down here at these swing lows, this is all sell side liquidity. Okay, so buy side is at the top, sell side is at the bottom. Now, hopefully you guys are okay and understand this so far. So all you need to know is just one way to find liquidity, and where lots of liquidity is resting is at swing highs. So as you can see, price creates this swing high here. Now this is our main buy side liquidity because it is at the top. So let's say we were to enter into a position down here, something like this. Our main target could be this buy side liquidity right here, just because it is at the top of all these swing highs and it is most dominant. So yeah, so the reason why these all swing highs is because we have price action up here. Then as you can see, we come back making a lower high, then we come back up making a higher low, sorry, and then we have this top of this candle, which is a swing high, and then this is our buy side liquidity, and then same here. So if we go to somewhere else, let me just use another example. So if we are looking right here, we have buy side liquidity here because it is a swing high. We have let me just type this out for you, buy side liquidity here. We have buy side liquidity here because it's a swing high, and we also have buy side liquidity up here. So hopefully this gives you a good idea on how you're going to find your zones to get buy side liquidity. And for sell side liquidity is the exact same thing, but just swing lows. So sell side liquidity would be right here. And yeah, I think you guys get the point for this. So it's just where swing highs and swing lows are in the market. So now, how are we going to use liquidity when it comes to trading? So as you can see here, we have my inverse model. We are respecting this bullish fair value gap down here, and then we create a bearish fair value gap. And what does price do? Price inverses this bearish fair value gap right here. So as soon as price inverses this fair value gap, my entry would be right here, and my stop loss would be a close back below this inverse fair value gap. That is my model. I just wait for liquidity. I wait for price to show me its hand. So as you can see, we're respecting this 1 minute bullish fair value gap. Inverse has been created. We inverse the inverse. So I would enter a long position right here. Then my first take profit would be the first buy side liquidity in this case. So as you can see, we have this buy side liquidity right here. So this would be my first target and my most important target, because price could easily come up to this point. If I was to enter a long position here, price could easily come up to this point, grab liquidity, and then just carry on going down, because all price action wanted to do was just grab the liquidity. Because as I was saying earlier, for price to move, it needs to have liquidity to be able to move. So price action could come up here, just wick through this liquidity, and then come back down. And that is why I would always take partials at this point, because it is the first most dominant buy side liquidity. Then my main target would be up here, but sometimes all the way up here might not get hit, just because we have all this buy side liquidity sitting in between. So if we play at the price action, I would take partials here. So I'd take off maybe 80-75% of my position here. Then I would try and hold my rest of the position to the top of the buy side liquidity. And as you can see, this played out nicely. But this was just an example. If we go back, I will show you guys another example just randomly. So here we have buy side liquidity again. So just marking out buy side liquidity. Here we have buy side liquidity here. So price always wants to take out some sort of liquidity before moving into a certain direction. Now I say always, price doesn't have to always go for liquidity. For example, we have liquidity down here that price hasn't took in this moment, but price still went up. So be careful for that. So if we was to enter a short position here, for example, our target would be the sell side liquidity right here, and as you can see, that didn't hit. Just an example. Obviously I wouldn't enter it into this trade, but this is just to show you that liquidity doesn't always have to get hit. Obviously knowing the higher time frame bias is very important once you are using liquidity for your targets, because if your higher time frame is right, then your trading is going to be a lot easier. So as you can see, this is a trade that I took with the silver bullet model all labeled out already. So we have displacement down right here. So our entry would be here with this fair value gap using the silver bullet method. So our entry would be there. Stop loss would be that. Now I've spoken about the silver bullet on another video if you want to watch that. Now my target would be here. Now why would my main target be here? And that is because we have this dominant sell side liquidity at this swing low. I could have also targeted down here and down here, as this is both sell side liquidity, but this was just too big of a move for me to want to go for, so I was just happy taking this sell side liquidity. But yeah, I hope you guys get the point and how you can easily use liquidity for your targets in the market. So yeah, I hope this video helped recognizing liquidity. If you have any questions, just put it in my Discord. I'll leave a link in the description. Thank you for watching.